Hello traders, this is Blake Morrow with ForexAnalytix and you're listening to the week ahead video for August 11th, 2019. Hope everybody's having a great weekend and hope you guys had a great trading week this last week. You know, it was a pretty explosive week last week with volatility and we've got a lot of things to actually discuss regarding the markets. But before I do that, I just want to make sure that I let you know that if you haven't tried out ForexAnalytix, it's only $1 for 10 days. You can see it right here, $1 for 10 days. Try it out. What do you have to lose? $1. Try it out for 10 days. Make sure you download the mobile application. So go to the Google Play Store or the App Store. Download the app. So this way you get all of our push notifications directly to your handheld device. You can actually put it on your, on your tablet as well. I don't know any other analysis companies that actually have apps, so you can have the stuff on the go. So, we do a lot of updates throughout the course of the week. We get a lot of, we have a lot of, support and resistance level breaches, patterns in play that get initiated, and then you can get notified when those are happening. So it's gonna be a great thing for you. So just try it out. Okay, now let's talk about this last week. So if you watched the week ahead video the previous week, we were talking about the U.S. dollar CNH. Here it is, breaching 7, and it Sunday night it happened, and we broke out, and that put a lot of downside pressure on the U.S. dollar Japanese yen. Excuse me. And the U.S. dollar Japanese yen actually, broke lower on Sunday, Monday. We're kind of been jostling around this 106 area, but frankly, now that we're below the 106 level, the risk is lower. A risk looks like we are going to move lower in the U.S. dollar Japanese yen. My 2 cents is, as long as the U.S. dollar CNH, the U.S. dollar, the won remains elevated above 7, the risk for the U.S. dollar Japanese yen to continue lower is high, because that's signaling to us that trade tensions are still high. And if trade tensions are still high, the yen is probably, at least this point in time, against the dollar, is going to continue on as a safe haven currency. Now, as far as this week goes, we have to keep in mind that it is Japanese holiday week. The observed holiday, I believe, is Monday. That might reduce liquidity a little bit in the yen, but overall, I think the dollar yen, moves maybe 30 to 50 pips higher from current levels. If we get back above the 106 level, or maybe the 106.30, might offer fresh opportunities to be on the short side. And as long as we stay below 107, I don't think there's any reason to be on the long side of the US dollar Japanese yen while the US dollar renminbi is above 7. Okay. Now, there's a couple other big developments in the market that I want to discuss. And if you look at the euro dollar, and I know the euro dollar has been just kept in pretty tight ranges because of all of the options that are expiring around current levels. But the fact of the matter is, last week, and we just did discuss this on the week ahead video last week, we had a false breakdown below 111. And I think that false breakdown below 111 still risks some upside. Now, this week, or actually yesterday, Saturday morning, it was very early in the morning. For those people that were in Australia that were listening in, we did. I was a part of a panel called Trader Fest, and with Boris Schlossberg from BK Asset Management, and a few other traders, and it's still going on today. But I was talking about the euro as being a funding currency. All right, you have to remember, carry trades, when market participants are, buying assets like, let's say, stocks or other assets, they fund their positions usually with a currency like the Japanese yen or the Swiss franc. They'll sell the currencies that don't yield much, or perhaps even negative interest, and they'll deploy that into other assets. The euro is a funding currency, and if we see risk appetite continue to deteriorate from current levels, the risk of the euro dollar, repatriation back into the euro dollar, is high. And I think the risk at this point in time is that the euro could actually break higher, despite all the issues that Europe has. Especially with like Italian politics and with the weakening German manufacturing data that we've seen. The euro could still, in essence, rally. Is the euro going back to 120? Is the euro going back to 130? Probably not. But could we squeeze higher in the euro dollar based on repatriation and positioning, because the market is short the euro? Absolutely. And I think that would be the trade that most traders don't expect, is the euro to rally. So what I'm looking at right now is the 112.50 level resistance in the euro dollar, and if that is broken and we get a daily break above 112.50, we might start to probe some of this key resistance. And then if you start looking at like the 113.20, 113.30 level, that we are in a descending wedge. All right, there's a descending wedge here. We hit the lower end of that wedge when we did the false breakdown below 111. A break above like 113.30, 113.50, that could be pretty bullish for the euro. So that's something, in my opinion, we need to pay pretty close attention to. I know a lot of you, excuse me, I'm sorry. I know a lot of you are going to ask, well, how about the cable? You know, I am really nervous about the pound. We are closing at lows that we have not seen since I don't know, the 80s maybe. The cable looks weak, and frankly, you look at the pound and how it's acted here. The cable could break lower. I don't know how low it can go, but I'll tell you this much: while the risk of a hard Brexit is prevalent, I don't think it makes sense to be long the cable at these levels. One of the things that I'm looking at in the pound, maybe to suggest that the pound may find a bottom, is if you go over to the euro pound. Let me show you the euro pound really quick. Here we go. The euro pound has broken above the 127% extension of this last move lower. I actually tried to play the pound on the short, or I tried to play the pound on the long side, being short the euro pound this last week. I ended up flatting the trade. I might have made a little bit, just because I was scalping on the short side as we were bumping our head up against like 92.50. I think I might have eked out a small profit, but overall, my commentary throughout the course of the week was, look, it's not pulling back. And for those of you that have been listening to my analysis for a long period of time, you've probably heard me say on several occasions over the years is, what does not go down usually only has one other direction to go. And in the case of the euro pound, the pullbacks were so shallow that the chances of a continuation break higher increased at the end of the week, and we broke above the 127% extension. So I think the risk is now that the euro pound pushes up towards the 161% extension, which will be around 90, what is that, 98 pence? I mean, that's, or actually 95. Let's talk about 95 first before we even start getting out there. The 161% extension is about 95 pence or so, and that is a heck of a move from here. Where does that put the cable if we get all the way up to 94.75? That could put the pound at 117, 118, 116. Depends where the euro's at, obviously, but I don't know if I really want to play the cable to the long side until I see the euro pound up at the 161% extension. Then I might think, oh, well, maybe the pound is due for a bounce. And it also depends not just about getting to a price. And that's one thing that I should point out at this moment, is that I don't necessarily put in a order to say, oh, I'm going to short the euro pound when it gets there. I want to know how it gets up there. Is it a spike? Did we get some sort of mini capitulation in price where the pound just plunges through stops, and then we reverse? I kind of want to see the price action once we get to that 95 or 94.75 level in the euro pound. I think the most prudent thing to do for you or for me is to set an alarm once we get there and see what's happening at that moment in time. How did we get there? How fast did we get there? What was happening around that moment? And then assess the situation from there. But I guess the point I'm trying to make is, do I really want to be long the cable just yet? Not me currently. A couple other currencies that we should talk about, going into the week ahead here, is we should talk about the peso. The U.S. dollar Mexican peso managed to close the week above the 200-day moving average. We've come off a little bit, but you can see the 200-day moving average is in this particular chart. It's this very light blue line. It comes in around 1937. The Mexican central bank, Banxico, is going to meet on Thursday, and analysts are split. I think half and half whether they cut rates or not. Remember, the world is currently in a race to zero, and Banxico has their rates above 8%. Could they start on a cutting process, or and be dovish and start cutting rates? They could, and if they do, the risk of the U.S. dollar Mexican peso moving higher, I think, is high. I will be keeping an eye on the U.S. dollar Mexican peso going into Thursday. Also, the Norges Central Bank, if you guys trade the U.S. dollar Norwegian krona, also is meeting now. A lot of people expect that the if there's one central bank out there that will continue to stay hawkish, it might be Norway. And if you look at their currency, the U.S. dollar Norwegian krona has been getting hit. We've pulled back. This may give you a good opportunity as long as we pivot around this 880 level. This might give you a good opportunity to be on the long side of the U.S. dollar Norwegian krona. Obviously, if they're extremely hawkish and they still keep their bias that they're raising rates, maybe we do actually break down below that 880 level, which would shift the bullishness that we've seen in the U.S. dollar Norwegian krona. Now remember, that is going to be on Thursday as well. There is other data that's happening this week. We do have some UK employment data. We have US CPI on Tuesday. We have Aussie employment on Wednesday, and on Thursday we have US retail sales and Philly Fed. Now I guess I should talk a little bit about the Aussie and the Kiwi. Those currencies have been obviously beaten down, and if you look at the Aussie dollar, it's extremely weak. The intensity of the U.S. China trade tensions have increased. That's kept the Aussie, on its back foot, and we've pushed into new 2019 lows. And I think the Aussie will continue to trade heavy as long as these tensions remain. Remember, their employment is on Wednesday night or Thursday morning if you're in Australia, but the Aussie remains heavy, and I think while we're below this 68.50 or so, the risk is lower. So we'll keep an eye on the Aussie dollar. One of the reasons why the Aussie has had a little bit of a lift in the pair is because the Kiwi dollar has been extremely weak and the Aussie New Zealand is squeezed. So take a look at the Kiwi. This is a central bank that you want to talk about a fall from grace as far as rates go. Back in 2010, 2011, the RBNZ rates were at 8% ish, somewhere up there. I don't have it right in front of right in front of me at this moment, but we were around 8%. Currently, rates are at 1. They cut rates half a basis point, surprised the market this last week, and they were extremely dovish, and they are actually toying with the idea of doing negative rates. It's not out of the realm of possibilities. Well, that weakness in the Kiwi has really pushed us to the limits as far as some pretty key support. And I feel that the New Zealand dollar still has room to fall. Some of you may not remember back in the early 2000s when the Kiwi dollar was below 60 cents. I believe it was below 60. I have to let's go take a look historically here. I have to, I believe it was 60 cents. It was like 55. I have to go back and take a good look. Oh yeah, we were down 40 cents. I mean, we were way down there. And by the way, I didn't like those levels at that time. Back when I was trading currencies, I was pretty new as far as currency trading. I bridged the gap between trading equities to currencies back in the early 2000s, and back here, when the Kiwi is around the 41 cents, and the trading range for the Kiwi and the Aussie would be, those, 20, 30 pips a day. I didn't like that back then. But if you look at, the scope of the Kiwi and where we could go, I mean, is it, you know, unrealistic to believe that if the RBNZ moves their rates into negative territory. I said Nates, negative rates. I just kind of meshed that together. Let me remind you, it is Sunday morning here, where I'm at, early in the morning too. We could be below 60 cents again. That's not beyond the realm of realistic possibilities. So I think the Kiwi has further to fall. And if you put two and two together, and you look at, if you think about, okay, well, how about if the euro rallies and the Kiwi sells off? Well, that's a perfect recipe, in my opinion, for a currency pair like the Euro New Zealand to really break out and revisit some levels above, 170, 175, 180, and maybe back up to a two exchange rate, or a two on the, big figure exchange rate. I don't think that's, like, again, beyond the realm of possibilities. So there may be some better opportunities in some of these crosses moving forward, especially if rates continue to fall in countries like, Australia and New Zealand. And remember, Europe's already at zero. Can they go beyond zero? Sure, but the ECB seems like their rates are going to be fairly steady around zero, but other central banks may continue to lower them. That could push up some of these crosses. Let me see, anything else that I wanted to talk about this week, be ahead of this next week. I do think that volatility may die down a little bit. Just remember, we are in the summer doldrums. I know we've had good volatility the last 2 weeks. This week, let's just keep a really close eye on equities. By the way, the stock market still is very strong here. Let's go over to the S&P really fast, and then I'm going to let you guys go. Here's the S&P. We had a nice bounce back. You can see this nice bounce back in equities. We're around the 618 retracement. I think there is scope for the S&P to move back to 2600, 2700, but this is going to be a real struggle. It's this little resistance zone that you see up here. I think the S&P could find some resistance around the, even if we hit new trend highs from this last week, where we had a decent candle on the weekly chart. There is some scope for some upside, but I think the upside is going to be limited in equities. And should we find a top in equities sometime this week, that's when you have to start looking at that dollar yen as being, maybe a continuation lower, back below 105.50, maybe back below 105. I think those are the risks. Now remember, guys, if you haven't tried out ForexAnalytix, make sure you do so. It's such a great platform. We've put a lot of effort into this platform for you guys. It's so customizable. All the alarms and all the settings, and whether you're monitoring Twitter from here, all these settings. It's just so customizable for you guys, and we hope you really enjoy it. So make sure you try out ForexAnalytix and check us out. And if you like this video and you found it informative for this next week, make sure you give us a thumbs up, especially if you're watching us on YouTube. And I'll see you tomorrow morning on the FACE webinar. Thanks for listening in. My name is Blake Morrow with ForexAnalytix. Have a great remainder of your Sunday.